Our 20th year of running the Growth Fund was a good one. I'm proud, though, not just of the 22% return for the year, but of our ability to consistently generate strong returns for you, our partners and co-investors, and ourselves, clearly. We've also done this with at least 30% cash every year for the last 6 years. What this means, it provides all of us with a much better risk-adjusted return, and certainly should help us when markets invariably turn down. So where are we in the cycle? What do the next few years look like? I've spoken to many of you over the last few months, and my message, I think, has been consistent. The returns that we've achieved in 2015, and in fact in the last few years, are not sustainable, and they will come off. For all equity investors, wherever you're invested, 2015 was a year where we have definitely borrowed returns from the future. Corporate profits are not growing strongly enough to justify the prices that are being paid. And it's not unlike the property market. Rents are not growing strongly enough to justify the ever-expanding prices and the continuing decline in cap rates. Both property markets and stock markets will go down as well as up. And admittedly, although we haven't had a downturn in the property market for 25 years, I think that means it's just getting closer. So what are the companies that we're looking at in the market doing to keep the share market satisfied, and why are the prices going up? Well, they're doing a couple of things. The first thing they're doing is they're actively making acquisitions, and they're making earnings per share positive acquisitions by borrowing money very cheaply and then overpaying private vendors for businesses and promising the public investors lots of synergies. Lots and lots of synergies. As long as the acquisition that these companies make returns more than the after-tax cost of the debt used to fund it, which is today about 2%, then the stock market is happy because I've brought in more profits than I've paid out in the after-tax cost of interest. Most of you will recognise that this is unsustainable. The second thing that companies in our universe are doing is endlessly adjusting their profits to eliminate so-called one-offs. This habit is now at epidemic proportions. And the most common of these is really laughable. This is the one where a business or a company overpays for an asset or overpays for a business, and 3 years later they write it off or they write it down. But when they do that, they tell the investors, the public shareholders, don't worry, because it's only a balance sheet adjustment. It doesn't involve a cash expense this year. Conveniently forgetting, of course, that the cash was paid 3 years ago and has now disappeared. This is happening right across the market more and more, and we spend a lot of time distilling our stock selection, making sure that we are adjusting for what are regarded as adjusted earnings. At River Capital, our stock selection has been very strong. One of the heartening things about what we've done and the way we've done it is that we haven't always got the portfolio weighting right, so we haven't always been high enough in those stocks that are doing great, but we're getting 8, 9, maybe even more out of 10 stocks right, and that's very heartening. And I think that's what separates us, together with our 20 years of experience, that like everything else in life, involves making mistakes, falling over, and learning from those mistakes. There's no substitute for experience in this business, like most, and unfortunately, you won't know it, we won't know it until markets turn down. So that's what we've got our focus on. Now, two of our best performing businesses in 2015 were RCG, and I mentioned that earlier, and Rightmove, and I'd like to invite Brad and Silvo to talk very quickly about those two businesses.
Thanks, Barry. So as Barry mentioned, RCG presented at our AGM last year. The share price at that point was around 64 cents, and hopefully some of you took the opportunity to buy a few post the presentation. We acquired our initial stake in the position back in 2013 at around 45 cents a share. Currently, the share price is $1.20, so we've enjoyed approximately a 2.5 times uplift on our capital, plus some dividends along the way as well. At the time, we were attracted to what is an outstanding management team, driven by a tenacious chairman in Ivan Hammerschlag, the defensive qualities of their Athlete's Foot business, and the growth prospect of their wholesale branded footwear business. In March 2015, RCG acquired Ascent Group for $200 million. From our perspective, this was both an astute and transformational transaction for the business. As a result of this acquisition, RCG now has multiple organic growth drivers in the business, and with both Ivan and Hilton at the helm, we think the business has a pretty bright future. And so we're happy shareholders.
I'm just going to talk for a couple of minutes about Rightmove. As you can see, the returns we've achieved have been pretty good, but I guess I want to focus more on a question that we get asked a lot in what differentiates us from some of the other funds out there. And I think the Rightmove example gives us, so there are two differentiating factors here which I can illustrate to you. It's the first one, I guess, is the best of what we call the best of breed approach. 2 years ago at our AGM, exactly this event, Greg Ellis, who at the time was the CEO of realestate.com.au or REA Group, he presented here, and we were investors in the company, happy investors. And as part of our due diligence, following the AGM, as we do, we got on a plane and went over to the UK and met with his counterpart in the equivalent business there, which is Rightmove. And we, for a business that was operating, both the market leaders, both in the markets of similar size, we found that Rightmove was actually a third of the value. So over, I guess, the next few months, we shifted our investment away from REA Group into Rightmove. And as you can see, the results have been quite promising. The second differentiating factor that this illustrates, I would say, is our key relationship with management teams. Similarly, that we have with REA Group, we, over the years, and we've known the CEO of Rightmove now for, I guess, 5 or 6 years, we've got a very close bond with him, and it's important for us that we can pick up the phone and call him. He'll answer our calls, he'll answer our emails almost immediately, given that we're on the other side of the world and it's a $3.5 billion business. Those two factors to us are critical in the sense that it gives us comfort and should give you comfort that we're investing in businesses where we actually have that call into management rather than just taking a punt. Rightmove's not the only example that fit under these criteria. We've come across a few examples around the world which our best of breed approach has sort of generated some great ideas for us. I would mention though the UK in particular has been a great hunting ground over the last few months, and we continue to see opportunities there. So it's a nice diversification tool for us. With that, I'd open it up to any questions for the Growth Fund, either on these stocks or any of the other stocks, or anything in general which you'd like to ask about this.
Certainly from my perspective, financially the business has never been in better shape. This year they'll report record profits. The key performance indicators for the business, including advisor numbers and flows into the administration platforms, are very strong. And the recent acquisition of SFW, which is the largest acquisition in the history of the business, has been integrated really well, on time and ahead of budget. Balance sheet strong, dividends are strong. So I think the issues raised are not material in the scheme of things. The journalism, or certainly the reporting around these issues, has been sensational in a lot of ways and factually incorrect. It's had an impact on the share price, but certainly no impact on the operating performance of the business. What I'd say is, as a result of this process, IOOF is going through an extensive review of its entire business, everything from compliance, HR, legal, and their research teams. And as a result of that, I think they'll come out of this process an even better business because I don't believe there's anything fundamentally wrong. So,
and I guess even to put it simply, our analysis in terms of downside is that perhaps it could get worse and perhaps it could be really bad. We put that at a very low percentage, not nil, but a very low percentage. Our view of the more likely outcome, which we put at a very high percentage, not 100, but a very high percentage, is that it will be business as usual, and we'll look back and reflect on this opportunity as a pretty good buying opportunity too. So, but comfortably, it's factored into certainly the FY15 result, and we think it provides a nice platform for growth into FY16 and beyond. So, fingers crossed that it goes according to our view. Any other growth fund questions on? Yeah, Mike.
Barry, do you see with your investigation and people on the ground floor, you ever taking a short position in companies?
No is the short answer. We'd like to at times because part of doing what we do is that we see a heap of overvalued businesses absolutely on the cusp of a disaster. And when the disaster happens, you sort of go, gee, 20 years of doing this, you start to get a sense of when that's going to happen. But the short answer is we don't. It's just not a focus. It's hard enough picking winners than trying to pick losers as well. Dave.
Are you spending more time looking at overseas markets, and if so, which ones are you focusing on?
Yeah, I'll let Brad answer that, but the answer is yes.
Yes. We have been, I guess it hasn't been the decision which we've made in the past 6 months. It's been a very slow progression, I guess, from 5 or 6 years ago. Every year we tend to explore the overseas universe a little bit more. We don't go over there and say we need to see X amount of stocks. We simply do it as, I guess, the next level of due diligence on the companies we're looking at here. We make 2 or 3 or 4 trips a year over there, both the US and UK, looking at similar businesses. And as a result of, I guess, now having made a decent amount of trips over the past 4 or 5 years, that universe has expanded, and the positions in the portfolio now, we've never invested as much in international companies. In terms of where we're doing it, probably at the moment, UK is a bit of the flavour of the month, but that can shift. At the moment, that's where we're seeing the value. We do have some US investments, but in a year it might be different. But right now, I guess we're favouring.
Yeah, I mean, it's interesting because in every sector of the market that we focus on in Australia, and David raised it earlier, there are competitors, contemporaries, trading as big companies overseas. And the recent example, David mentioned Ramsay, which has been a long-standing investment of ours here in Australia. But, we came across one of their contemporaries in the UK, Spire, which is not nearly as good a business as Ramsay because it doesn't have the Australian dynamic that Ramsay has. But in the UK market, where they also compete with Ramsay, it's very, very well positioned. Now, it's not nearly as good a business, but Ramsay's trading on 30 times earnings here, and we started buying Spire on 12 and 13, and they own the freehold. So occasionally, we hop, once again, because we've got that sectoral focus, we hop on the plane, meet with the Spire management, develop enough of a rapport and enough comfort that notwithstanding we're a long way away, we can learn a little bit more about it, and it's been a very successful investment. And there are a number like that where our targets come from the fact that we have been so focused on healthcare in Australia, but what's happening in the UK, what's happening in the US. So we're not just looking at those going overseas to find companies, we're sort of targeting companies in sectors that we're already familiar with.
How do you manage exchange rate risk?
It's a good question. Easily, we don't. So we buy the currency at spot rates when we make the investment. We convert the dividends into Aussie dollars when they come in, and we convert the foreign currency into Aussie dollars when we sell the investment. So it's very unsophisticated and very straightforward, and I like it that way. It means that we don't overcomplicate what we're doing with views on the currency. We spend all of our time focusing on the underlying business. I've had some people say to me, well, if that's right, why don't you take the currency risk out of it and not worry about whether the currency goes up or down? I guess being the sort of fund that we are and having so much of our own capital in the fund, there is a comfort in having both a pound sterling and a US dollar exposure as well. So sometimes it works against you, and it did when the currency obviously went to at parity and beyond. Sometimes it works for you as it is now, but we're very comfortable having a percentage of our collective assets exposed to the pound and the US dollar, and therefore we don't worry about it. We just convert it at spot when the cash comes in or when the cash is needed.
It's also worth noting a lot of the businesses that we invest in Australia have, in the case of Ramsay, for example, they've got a UK business, they've got a French business, so there's inherent currency risk within the business. Similarly, some of the overseas businesses we're investing in, they've got foreign currency risks of their own within their own operating businesses. So we view it to start being a bit cute and trying to execute exactly where the currency risk lies, we find it would be a bit more difficult.
How do you balance wanting to invest in a good company and your cash position, waiting for a downturn? Because you've got to move forward and still get returns. You don't want to miss out on any extra returns, but you also know that you may be paying too much, or do you increase your cash position, or how do you view that?
It's a great question. What we don't do is we don't say the marginal cost of the money is 2.5% or 3%, and therefore something generating 4% is better than that. So what we don't do is try to enhance our cash by just investing at any price, because ultimately we're investing in businesses and they're risky, and they do deserve to be at a premium. You do need a higher return to reflect the fact that businesses are riskier than having the cash in the bank. So that's the first thing. The second thing is, we go through a pretty rigorous exercise with every company that we see in our universe of companies, and we need to be able to stand in front of you and say, we believe, hand over heart, that this company can generate the combination of capital and dividends, 15% per pre-tax return on our investment. And so that might not all happen as it did in the year just past. We got some of that brought forward, but the idea is that over a meaningful period of time, and typically we're looking out 5 years, which has its challenges, of course, in terms of assumptions you make and all those sorts of things. But that's what we do: is rigorously go through every company and make an assessment of what we think that company, no different to if you bought any asset, what's it going to generate over the next 5 years in terms of returns, both cash and ultimately the growth in the income. And we still have that target with all of the businesses that we look at 15% pre-tax. Now, we've been selling some great businesses over the course of the last 12 months. Really painfully so, in terms of businesses that we've been attached to for a long time, because we can't see that return at 15%. Now, I think you have to stay disciplined to that. Will we get an opportunity to buy those businesses at cheaper prices? Well, in one case we're looking at that now. It's happening. In another case it's continued to go up. So you don't know, but that's our discipline. That's how we do it. I'm not a believer that you can buy a good business at any price and then the returns take care of themselves. It's not the case. Your purchase price is important, as it is with every asset class. Does that?
Yeah. Well, just in relation to the cash position, are you slowly increasing your cash a little bit more, just given the valuations, or it sort of still stays around 30 or 40%?
It's almost a secondary consideration for us. We're always motivated to make sure that our investment decisions stack up and that we can see a return. If we can't, we'll sell it, and if that means the cash holding increases as a result, then so be it.
But it's still around that 30%, 25 to 30%. Elliot, we are finding things to buy, and we are deploying cash every day in exciting opportunities. So notwithstanding some of the warning signs that I talked about, we think we're able to filter through that and find those opportunities, be it in the UK as we talked about, or even here. But at the same time, we're also selling companies that we've owned for some time, where we think people are overpaying us for them. So it's about a wash at the moment, to be frank, in terms of what's going in and what's coming out. But so that leaves it about 25 to 30%. But I think our expectation is we'll probably be net buyers still over the course of the next 12 to 18 months. We've done a lot of selling in the last 12 months.
Thanks.
To Brad or Silvo, what sectors are exciting you at the moment, seeing as the market is fairly?
That's a tough question. You're really tough. Now we're seeing, we are still finding some opportunities certainly in my universe. We're deploying capital in the fleet leasing sector. There's a few businesses that have come onto the market over the last 6 to 12 months, which are really well-run businesses. We've done a lot of work. Valuations do look attractive, and we're deploying some capital there. And opportunistically, technology, we continue to find good businesses there. We're working very hard. There's no particular sector as such, but there's businesses that we continue to identify.
I think for us it's more about finding the key ones within the sectors. We've sometimes got sector bias, but it's more when you're looking at a particular sector, what's the best within that sector? And when I say best, both from a quality of business and valuation perspective.
But I think, Philippa, one of the things that we probably do reasonably well is we can tell you straight away what we don't like. So if you bring an idea that we've learned over the journey what we don't like, and it might be attractively priced, it might have a great management team, but if it's making trucks, we won't be buying it. And just because we don't want to, or if it's making pies out of a factory in Ballarat, we probably won't be buying it, even if it's the best branded pie in the country, because of perhaps a natural bias against businesses like that. Technology, software businesses with a natural bias towards, and we've done very well from. So if you introduce a software business to us that's priced at has a long history of profits and priced at a reasonable price, there's a good chance we'll be looking at it. Medical services, you've introduced a few businesses to us over the journey. One we said no to, which was a mistake, and a few we've said yes to, which have been good investments. So part of the art is also not saying no to businesses that end up being great investments. We do that occasionally as well.
I think the other thing to say is that over the last 6 to 12 months, we've seen quite a lot of new companies come into our universe through the IPO process. So we are, working diligently through those businesses, and 1 in 10 ends up being a pretty good business, and we think we've sort of picked or identified some new opportunities as a result of that. So, and I think over the next 12 months, I will certainly expect a few more IPOs to come our way. That's an ongoing thing.
Just one more.
Yeah.
Barry, you always mentioned about how you want to have a great relationship with the management of the companies. So, for instance, like when the company is very big, like Sydney Airport, and you're just a very small shareholder, how do you, get the attention of the management team in that instance? And if a CEO is really good, and you want their attention, but they're not giving it to you, how do you turn that relationship around?
What about small Australian funds turning up on the doorstep of UK companies and US companies and trying to convince them to give us an hour and a half of their time The amazing thing is that in the stock markets around the world, the average holding period for stocks is now measured in days, not weeks, not months, but years, but days. And so when we turn up, be it to Sydney Airport, or be it to a company that's £3.5 billion in the UK, or even a bigger company in the US, the one thing that we're met with every time is delighted to spend time with people who have actually taken the opportunity to learn about our business, come in with questions. There is an absolute, from a management perspective, they are so desperate to talk to people that are actually interested in the business for a meaningful period of time, when the markets at the moment are totally taken over and controlled by traders that are literally measuring their holding periods in microseconds. So we don't find it difficult at all. Well, there are obviously occasional situations where you need to develop a rapport over time. That might come from going to a group presentation and then going up to the managing director at the end of the group presentation, introducing yourself and handing a business card and saying, love the story, can we take an opportunity to follow up? And very few, most of the good companies are run by guys and girls with good emotional intelligence. And people with good and high emotional intelligence will not refuse to meet people who are genuinely interested in their business just because the size of their fund isn't large. In the same way as they wouldn't refuse to meet with a shareholder who called them up and said, I've got an issue with your business even though I only own 100 shares. So you're talking about, you've already filtered people with higher emotional IQ than the guy who's sitting there running a business with a totally different perhaps aspect and view on things.
I would just add some of the what are now bigger positions. When we first invested, like a Sydney Airport or an intercontinental exchange in the US, they were a third of the size, and at that point they were, we developed the relationship then, and only now they're bigger, but they've still maintained that relationship with us because, as Barry said, it's we're the ones that have hung around for the time. So they're happy to continue that on.
I mean, Ramsay's got a $13 billion market cap, and if we fire ring or Barry rings Chris Rex, he'll return our call very quickly. And we got to know him when it had a $1 billion market cap, and so it's we work very hard on that aspect.
We might move on and just in the interest of time, and talk credit and I think, finishing up, what I'd like to do is also, you've got Brad Masilvo and I up here, but the Growth Fund team is actually deeper and wider than that, and I'd like to, I can't see them here, but they're not far. I can see Anthony, Ravine and Charlie, and I'd just like to, from an investment perspective, these guys are at the coalface with us, doing a lot of the hard work and analysis. And whilst we're sitting up here, I want to publicly acknowledge you guys and the time and effort that you're putting into making this a successful business. So moving on, what I'd like to do is move on to the credit business and invite Josh and Andrew to come.